Hey everyone, Mark Rushin here, back for another video. Thank you to all of you that have reached out so far with various questions or just to connect, because we are growing a community here where we are all looking to build wealth together. It is my mission here with this YouTube channel not only to deliver financial knowledge, but to do it in a way that is easy to understand for everyone at all levels. So please, if you haven't done so yet, hit that subscribe button and also connect with me on social media, whether it's Twitter or Instagram, or drop a comment down below. In order to promote this channel moving forward, please hit that like button down below, as that will spread our videos out for more eyes to see and for our community to continue growing at the great pace we've seen so far. I have received numerous questions for those of you that have reached out, and in today's video it is my goal to hopefully answer some of the key questions that you have sent. A lot of them stemming from the very first video we put out on 4 ways to start investing. And that key question that I'm referring to is, what are the different retirement accounts and which one works for me? So in today's video, I'm going to give you a brief overview of some of the main and some of the most popular retirement accounts out there so that you can see which one fits your strategy and your needs moving forward. If this is what you've been looking for, then stay tuned. As always, everything shared in this video today is for educational and informational purposes only. Although I am a CPA, I'm not a financial advisor, so the opinions expressed in this video today are those of my own. When it comes to retirement accounts, here are some of the most common that you have available to you: the traditional 401k, the Roth 401k, the traditional IRA, the Roth IRA, and the self-employed IRA or self-employed pension plan. Let's begin with the traditional 401k. One of the most common benefits out there today, this is an employer-sponsored event, meaning that the company that you work for must be signed on to offer this benefit to their employees. Now again, not all employers offer this benefit, but it has become very common in the workplace today, at least here in the United States. Currently, the maximum that you can invest in a single year is $19,500. Now, if you're over the age of 50, they allow a few extra thousand as a catch-up. A traditional 401k is an employer-sponsored account, and to make contributions, you use pre-tax dollars. So this will lower your taxable base on what you'll be taxed on at the end of the year. So let me put it this way. Let's say that you make $50,000 per year, and you decide to contribute $10,000. Take your $50,000, subtract out your contributions made into a traditional 401k, and the amount that you can be taxed on now is only $40,000. So you've lowered your taxable basis and you've contributed towards your retirement. Now this money will grow at tax deferred, and what that means is that you can withdraw the money after the age of 59 and a half, but any gains that you have made over those years will be taxed at the rates that you're at during those years. So let's say that you get to be 65 years old and your rate has actually gone down to say 10 or 15% because you're retired, you're no longer working and earning a strong salary like you had in the past. Now you can take that money out at lower taxable rates than you were in previous years when you were younger, making a higher salary. Now some of the downfalls with the traditional 401k is, let's say your tax rates go up, so that when you're 60 years old and you retire, but you're still earning a great income, or your investments are bringing a ton of income, or you have a bunch of rental property, whatever it is to make your income keep you in a higher tax bracket, and tax rates have increased over the years, well, that tax deferred has now, you got the tax break up front, but now later down the road, you're going to be taxed on these dollars at a higher rate. This could be a potential downfall. Other downfalls include the lack of investing opportunities, or options, I should say. You don't get to pick all the funds that you want. You have the limited number of funds that your employer or the employer sponsored has signed you guys up for. So that could be, maybe a dozen options. You could have some target date funds, you could have some broad-based funds with, you know, some S&P 500 exposure, or maybe some real estate or REIT exposure, but you just have a certain number of funds available and you don't get the exact ones. If you wanted the Vanguard ETF VOO, that's not likely going to be an option in your traditional 401k. Next, let's turn our attention to the Roth 401k. Again, the structure is very similar. It's an employer-sponsored account, and it has gained a lot of steam over the years where employers are offering both a traditional 401k option as well as a Roth 401k options. Now, when it comes to what's best for you, that's a personal preference and what you think. Where's your income going to go over the years, and where do you foresee tax rates going over the years? Now, there's no one out there that knows where tax rates are going to be 10, 15, 20, not even next year, really. So that's all a personal preference on what you think and where you're headed on your career path. So let's say that you think tax rates are going to increase, and you're also in an industry where your income is going to continue to increase, and you're going to continue to add multiple income streams over the years where you're going to be climbing that corporate ladder or climbing that tax ladder. Well, the Roth 401k option might just be best for you. Let me explain. So with a Roth 401k, you are going to use post-tax dollars. So these are dollars after all of your taxes have been pulled out of your paycheck. They are then contributed in. So you're paying the tax up front. But any gains that you receive after you make your investments, let's say you're 30 years old today and you continue to contribute to your Roth 401k, any gains on those contributions over the years are yours after you start withdrawing them after the age of 59 and a half. So the balance that you see in there, let's say you have a balance of $500,000. If that balance is in a traditional 401k, you're going to be taxed on that balance. If that balance is in a Roth 401k, that is 100% your dollars. Same contribution limits go for a Roth and a traditional 401k. You have $19,500 to contribute. You can actually mix between the two, or you can put as much as you want in one up to $19,500, or as much as you want in the other up to $19,500. Just between the two, you cannot go over $19,500. Next, we will turn our attention to the individual retirement account, or the IRA, which has been a popular retirement option for a number of years. Now, the IRA offers a ton more flexibility to where you can invest in individual stocks, whatever ETFs or index funds you choose. It is the same setup as a traditional brokerage account, a taxable account, except it's a retirement account now. Similar to a traditional 401k, you make pre-tax dollars when it comes to a traditional IRA. So being that these contributions are pre-tax, there are income limits that could refrain you from getting that tax deduction. Let's take a quick look at the income limits. In order for your contributions to be tax deductible, a single person can make $65,000 or less. A married couple can make $104,000 or less. Now, these contribution limits will phase out as you climb the ladder higher. Let's take a look at what the max amount you can make in order to have a traditional IRA. In order to have a traditional IRA, to get some sort of tax deduction, you can make no more than $75,000 as a single filer. If you are married filing joint, you can make no more than $124,000 combined. So you need to take these contribution limits into consideration when signing up for or when deciding which retirement account is best for you. Next, let's move to my favorite retirement account, which is the Roth IRA. Now, if you recall back when we were discussing the Roth 401k, the contributions are going to be similar in that you are making post-tax dollars. So you're going to pay the taxes at today's rates, and then any of your gains are going to grow tax-free, so that the amount that you see in your account will never be touched by Uncle Sam again. Also, the same goes for the traditional IRA. You can invest in individual stocks, ETFs, index funds. You can even do options trading when it comes to an IRA. You don't have that flexibility with the 401ks as we saw. You are stuck with the individual fund options that your employer and their sponsors are offering. With the traditional IRA and the Roth IRA, you control what you invest in. And these are some great benefits between both of these accounts, but I love the tax-free growth that you get in a Roth IRA. Now, when it comes to IRAs, you're also able to withdraw without penalty the contributions that you make. So with a IRA, you are allotted $6,000 per year, much less than you are allotted to contribute with the 401k. Remember, with 401ks, you're allowed $19,500. But with the Roth IRA and the traditional IRA, you are allowed only $6,000 per year to contribute. Now, some things to note here. Because with a Roth IRA, not everyone can individually contribute to a Roth IRA. If your income is too high, you could be excluded from having a Roth IRA, or I should say, from contributing directly to a Roth IRA. In a second, I will go over what's called a backdoor Roth IRA option for those in the high income earning brackets. Again, as I mentioned, contributions can be withdrawn without penalty before the age of 59 and a half. Now turning our attention to the income brackets, those that can't contribute directly to a Roth IRA or have a Roth IRA due to their income being too high is those single filers with a adjusted gross income of $140,000 or more. Now, if you're married filing jointly, that number is $208,000 combined. So if your income or your combined income for those that are married is above these thresholds, you might think, well, shoot, I can't have a Roth IRA and have my money grow tax-free. Well, hold on. There still is a way to do it. And let me explain. This is what's called the backdoor Roth IRA. So as I mentioned before, if your income is above these amounts for either single or married, you cannot contribute directly to these Roth IRAs. But the backdoor option is you open a traditional IRA, because there's no income max limits when it comes to opening a traditional IRA. It just comes down to, is your contribution tax deductible or not? So if your income is too high to open a Roth IRA, well, that is likely going to mean that your contribution to a traditional IRA is not going to be tax deductible. But that's not what we're worried about. This high earner is going to contribute to a traditional IRA, and then once per year, you are able to roll this over into a Roth IRA. So to do this, you're going to open up both accounts. You're going to open up a traditional IRA account, and you're going to open up a Roth IRA account. Now, the current tax rules exclude the high earners, again, from directly contributing to the Roth IRA. But the backdoor option is the high earner contributes to a traditional IRA, and then the traditional IRA contributes to the Roth IRA. That is what is called the backdoor Roth IRA. Now, you can only do this transaction once per year, so make sure you plan ahead. Also, I must note that if you have money that is rolling over from a 401k, because you can roll over old 401ks into IRAs of your choice, but if you're rolling over something that was a traditional amount, meaning it was a tax deferred account, and you're rolling it into a Roth account, whether it be a Roth 401k or a Roth IRA, there are tax implications. So make sure you discuss those with a financial advisor before doing so. Lastly, we'll briefly discuss the self-employed pension plan, or the SEP IRA, for those of you that are self-employed. The SEP IRA is set up very similar to the traditional IRA, except you have big advantages when it comes to contributions. Those of you that have a SEP IRA can contribute the lesser of $58,000 per year, or 25% of your compensation. Your money is going to grow tax deferred, so that you're going to put the money in, and as it grows, once you decide to withdraw that money, hopefully after the year 59 and a half, so you aren't assessed a penalty of 10%, you will be taxed at whatever income bracket you are at that moment. So there you have it. Various retirement accounts that you have at your disposal. Now again, all employers may not offer these benefits such as 401ks, but anyone can invest in an IRA, whether it's a traditional or a Roth IRA. You just need to decide which one is best for you and where you see your income going and where you see taxes going over the years and how you fit into the various tax brackets moving forward. I hope you enjoyed the video, and if you haven't done so, again, please hit that like button, as that is huge for the growth of this channel moving forward, and consider subscribing so that you are notified anytime we drop new content. I hope you enjoyed the video, and we will see you next week. Take care.